Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, July 13th, 2022. It is 2:28 p.m. as I'm starting the video, so we've got about an hour and a half left in the trading session. Wanted to do a video on the really what I've been posting a lot of today, which is the stock market and precious metals, including the mining stocks. Quite a few trade ideas. I got some new ones out to you today. We recently had one on palladium long there, and got out some additional metals, both precious and industrial metals today, platinum and copper. And then wanted to go over that what's going on with the mining stocks. So we're going to start with the stock market, and let me say this: right now is a time where I'm reading some comments, got a lot of differing views, and I want to say this: I very, very much welcome that. I actually prefer different perspectives. I don't want I don't think it's healthy. I don't like when everybody agrees with me. I like not always being a lone wolf, but when the consensus is pretty bullish, as it was back here, the majority. And I'm not talking followers on the site. I'm talking just the consensus in general out there. Most were bullish. And would laugh at even the odds of a recession are very small. Let's just say I've already talked on that. That was very clear if you go back towards the end of last year, beginning of this year. Very few had a recession coming. And then, as I've covered lately, we've seen a ginormous spike, the biggest spike ever in interest in the term. Can go to Google Trends and see the search term recession spiked, and that's all you hear about now. Not, are we going to have one? How bad's it going to be? And how to position your portfolio. And so while the sentiment indicators have not triggered levels where I usually indicate a correction or a bear market's over, nor do I think this bear market is over, from that kind of again, more of a gut feel, just going off where everyone's at, that puts me to the bullish camp still at this point in time. And I'm talking for the next few weeks to maybe even a couple months here. We'll see how things go. And I also continue to maintain, although I still maintain these downside targets, I think the downside is relatively minimal, and at best it's roughly 1-to-1. In other words, if we jog down and hit my final target from where we're at now, you're talking maybe 20% downside, but I could easily see as much as 20% upside. That's a 1-to-1 risk-reward ratio. Therefore, I'm just not comfortable being short here. And the other thing I want to mention, and just keep this in mind, if you are short looking for more downside, is there is and it's usually gradual shift, but a trait I look for in the market, and that is how good and bad news is treated. Okay, so in a bull trend, bad news is shrugged off. Good news is good news, and the stock market will rally or continue to rally, I should say. And bad news is shrugged off. It's either good for a little pullback, and then that gets bought up, or it's completely dismissed. And then when you start to see in a downtrend the inverse happen, you start to see bad news being shrugged off and good news causing stocks to rally. So say what you want about where you think the market's going. Well, what we know for a fact, and this is the day I pivoted, closed out last of the shorts, went to a long positioning, swing trend, and we're up. We're up from that point, and as I showed you on the 60-minute chart, there's a trend line now as well that comes into play, and so we are in a near-term uptrend. That could end tomorrow, could end next week. We could take out these lows, and if we do, then so be it. At least there was a nice tradable rally so far, which was already good for about 10%, and I'll take that all day long. So the point that I want to make, and more focus on, let's talk about that good news, bad news thing, and reflect upon this. Okay, right now, as of now, the market's up. This is the Nasdaq 100. Not big. We're off the highs. I'm going to get to the intermediate, the shortest term charts today. Show you the ones I trade off on a micro level, actively trading. But we're still up. And remember what we did today. We recouped a big drop. We were up here. The futures were even higher this morning. I think from high to low was about a 4% drop. But so far they gobbled up from the lows. They reversed all of the losses and then some. At one point, we were up almost 3% off this morning's lows, and we're still comfortably off those lows right now. So, where am I going with this? Okay, remember the headlines today. Here, this is the homepage of the journal. Inflation hits 9.1% as prices rise broadly across the economy. Gasoline costs, highest rise in CPI since 1981. Other headlines that came out, they said it was the highest inflation reading in almost 41 years. And so that in itself, I think we can all agree, that headline could not possibly be any more bearish, right? I think we can all agree on that. And I'll show you something else in a second, what it did to the Fed funds futures. Yet here we are up today. And here we are, let's see how many weeks after, 27, almost 28 days, nearly a month after the market bottom, we're still zigzagging higher. Again, let's not make too much into it. You know, I always say one day doesn't make a trend, but a month starts to make a trend, at least a short-term trend. So again, on what probably could be a more bearish headline, the market in the initial knee-jerk reaction. This is why I say always don't trade. Be cautious of or skeptical of knee-jerk reactions on market-moving events, Fed meetings. You had the Beige Book report come out today to knock things down. That was kind of priced in on the charts. I'll show you what I did there. But all right, so that's that. Take it for what it's worth, but recognize what's happening now, and that is, again, you're seeing bad news being just shrugged off, and those dips are being bought up as of now, again, at least for the last month. Maybe that trend ends soon. Maybe this is just a bear market rally. Okay, so I think I've said enough on that. The other thing I wanted to show you is, let's take a look at this. 1 second here. Okay, now what I have here, these are the Fed Fund futures. You can get that. Just Google Fed Funds futures. The website cmegroup.com, and then you can get in there. And what they'll show you is this is by far, and this is the gold standard for figuring where traders are laying where the pros lay their bets. Very few of you out there probably trade ZQ. I've traded before. I bought it today. Went long. ZQ of the Fed Funds futures, and that's the futures contract for the Fed's fund rate. So this morning, I believe, before the CPI data came out, they were pricing in, I forget where it was, I think it was under 10%, around 8% or so, very low chance of a full percentage point. The expectations before were for 0.5% to 0.75. Remember, when I say the expectation, not where people are running their jaw, on TV and throwing out their 2 cents. This is where, again, professionals, institutions primarily, are placing their money, they're betting, and that's like I always say, I kind of take the AAII sentiment surveys with a grain of salt, because that's where just people are bullish or bearish in rhetoric, and that's why I've always said I prefer the put to call ratios, because that's showing people putting their money where their mouth is. They're betting with their money on puts or calls, and to me that's a more accurate measure of market sentiment, and therefore this is the gold standard of where folks think interest rates are going. So after I did this, I pulled this up a little before the video, and I'll refresh it and we'll see if it's changed. My guess it's going to abate, go down. But what happened is they shot up. This right here, here's how you read this, by the way. The target probabilities for the July 27th Fed meeting, the current target rate, this is the current federal funds rate, 150 to 175 basis points. That's where we're at now. So when you see a 74% chance of a 200 to 275, that's a 1% increase in the rate. Okay, so that's how you have to read this. And then 225 to 250 is going to be the 75 basis point cut there, or hike there. Okay, so now that's pretty much, this by far shot up, and after the hot CPI numbers today. So now that, and again, that was a change from before. So my goodness, if that didn't knock the market down, and it didn't so far today, and again, I want to be a little, I just have to get this out there. One day doesn't make a trend. Maybe the market gets knocked down tomorrow. Maybe JP Morgan says something the market doesn't like. But as of now, they had the knee-jerk reaction. I talked on that earlier, probably cleared out, I undoubtedly cleared out a lot of stops on weak-handed longs, and probably sucked in quite a bit of shorts, which are now feeling the pain because we've recouped all those losses and then some and turned positive. And so To me, again, I'm just showing you an example of what's going on now, regardless of what was probably the worst. This is I can't even recall the last time. It'll probably be in the headlines say the last time that we got a 1% hike in the federal funds rate. It's been a very long time, and it's going to be measured in decades again. I'll probably get that statistic. If I get that statistic, I'll share with you later. And yet, the stock market's up. Okay, so let me refresh this and see what happens, because I'm betting this goes down. Now, listen, the Fed, as I said before, I'm not going to bet this hard because the Fed, you guys know I'm pretty critical of the Fed. I think they just, for as powerful as they are, they don't know what they're doing. It's been forever, for decades. They've been always behind the curve, reactive, not proactive, and so it wouldn't surprise me if they go ahead with this. But on the flip side, I've already made the case, and again, they're not talking about this, but I'm showing you real-time abatement in the inflation data, or the actual cost of commodities and things like that. And we have a little bit of time. We'll see if that comes up. And if so, we swing back to a 75 basis point hike. If that's all we get, I think the market could explode. Why? Because this now, as of today, this is what is the expectation. This is the expectation by far. You have a nearly 3/4% chance that we're going to get. I'm sorry, a 75% chance we're going to get a 1% hike as of now, and then only a quarter point, 25% chance, 26% of the 75. And so therefore, that would be bullish if this changes. Let me just see, since I took this up, if that's dropped down. Yeah, a little bit there. Yep, it has a little bit. Good. So yeah, my ZQ should be up. This is ZQ right here. Let me find the chart for you. ZQ right here. So there's you can see what happened. This is the Fed funds futures contract. This is actually for the August. I like I like the volume. I'm going to hold this one and see if this will come up. You can also go with, of course, July contract. But so this is where we were, and then this is with the hot CPI number this morning. And if we get that, then that's going to stay around there if we get the 1% hike. I also think if we get the full percentage point, it's going to be with either the verbiage or the at least if not explicit, an implicit understanding that they are probably front loading the hikes, and that'll be it for a while. So again, I'll see what the market does. Right now, the market's fine with that, and it's shrugging off a huge surge in the chance that we're going to get that 1% hike. So I just wanted to talk on that, and again, and say how that's one of many things, and also think back over last month, all the bad news that's rolled in, and yet the market has stair-stepped higher since then. All right, let's talk about the market a little, and then we'll get off there, and I'll go to the precious metals here for you. But there's that big 285 level. Remember what I said this morning? I think I wanted to see, and I expected it, and that's what we got to recover that. So there was a big potential bear trap there, the breakdown, then the recovery, and then we've had several back tests. So the way it works is support once broken becomes resistance, resistance once broken becomes support. We regained it, and so far we're above it. We also took out this minor downtrend line and just back tested it. And then if you actively trade, I always say go down to the 5-10 minute charts. This is the QQQ chart today. You can see this morning there's a big drop. This is yesterday's close right here. Big drop. We ran up, then we took out this downtrend line right here. Right there, we broke out, but we also had an uptrend line. I had two alternative uptrend lines throughout the day. Came up here, and that was big resistance. So why I grabbed a bunch of shares there, extra NQ contracts. Lightened up there, half the position, my entire position, just to get out. Then we had the beige book hit right here at 2 p.m. Took us down to that good support. There's that 285. That's 285.06. So that's where I recycled back in, and that's the level. As long as we remain up above that level, I view that as bullish, because there was our potential bear trap down here once we recovered it. And so book profits on those longs. That's a quick, from buying the dip At the open, that was about a 2.8% rally up there. Big resistance. Of course, we weren't going to go through there without at least a reaction. You can see that's, look at all these reactions on QQQ at the 288 level. And remember, always sell. If all eyes are looking at 288.21, you want to sell below that. Don't wait till the last, don't try to squeeze out the last penny on a, on a 288 point security. And I'll use QQQ and NQ charts together. Usually during the regular trading session, usually but not always, it's QQQ that has more significance because that's where the majority of the money flows are controlling the Qs. The Nasdaq 100 is an index. You can't buy or sell it directly. You trade it through a proxy. One proxy is QQQ. It's an ETF that tracks it, inflows and outflows to that ETF, then turn around and result in buying or selling of the basket of 100 stocks. Same thing with the futures, etc. So. And again, there's a lot of this is where most of the volume goes on during the day, and then the futures also are trading, so you want to watch both levels. But there it is. So you can play ping pong, trade these little levels, buy pullbacks to 285, and the next bullish development is going to be a breakout of that 288 and a quarter or so level there. Should run us up. This is not a hard line here, so this is more of a fuzzy level. There is a gap here. This is where I'd expect the next decent reaction, but it depends on how the charts look at the time, of course. But, all right, so that's where we're at today. And again, the takeaway is so far so good. One day doesn't make a trend, but I do like what I saw today with all this. Okay, and then we'll move on to precious metals. And again, I say this all the time, but I think it bears repeating. Yeah, this is one trade, and I'm either going to be right or wrong on this one trade at this point in time. So far, it's been a great year. I've made really good money on trading the Nasdaq 100 futures and the small caps and some other indexes here and there. On the way down, nobody bats 1,000, but batting well over 500, well over that this year. And that's that. Let's now talk about the precious metals. Now these I've been calling for a while. Historically, I've done really good calling gold and silver. It's been for a while now calling, trying to look for a rallying gold that just hasn't come. It's been walking its way lower. But if call me what you want, but one thing you have to agree is I'm tenacious. If I see a move coming, I will stay on that move, even if I go underwater, get stopped out on positions, and I still like gold. So what we have today, I'm on GLD. We have a bullish engulfing candle on GLD. That you look for candlestick reversal patterns. That is a reversal pattern. Number one, you only look for a bullish engulfing candle at the end of a prolonged downtrend. That's what we have here. So that is at this point in time a potential reversal stick. And when it's a reversal stick, as the name implies, that is a trend reversal. It's not for a bounce trade that lasts a few days. If it sticks, and these aren't, there's nothing 100% in trading, but if it sticks, then you have a pretty good chance. And what I'd like to see is follow through. Meaning tomorrow, if we do get this candle finalized, I want to see another green candle. If it's not green, if it's red, as long as we can't violate the bottom. If you violated the bottom, if you drop below there, then that wasn't the bottom. It's not a bottoming stick. It's not a reversal. So let's see if we can get some upside from here today, assuming that we don't tank into the close. All you have to do is close the body of this candle. This green one has to engulf the body, the fat part of that previous candle. So far looking good. Here's an example of a bullish engulfing that wouldn't have been a reversal stick right there. It was a bullish engulfing candle, but it didn't come at the bottom. This one might have engulfed there, and there was a trade to be made, but it wasn't the bottom. Again, nothing's 100%. This was an island top, pointed out at the time. You have a gap up separated by gaps on both sides. That's an island top. That's one of my favorite reversal patterns right there. All right, so we'll see where this goes. You still have the divergence building there, not on the RSI, but you do have oversold reading. And then on GDX, that's the one I wanted to get to. Threw this out as a trade idea recently, and there you have also a bullish engulfing. See, that big green candle was not a bullish engulfing. It was below the body. The top of the body on that green candle was below the top of the body on that red candle the prior day. So as of now, as long as we can close above that level I gave you, whatever the open was on that one, 2665, I think that was, we'll have a bullish engulfing candle. So then I'll look for confirmation Still doesn't guarantee anything, but just increases the odds if we can get some follow through tomorrow. And then I gave you my targets. I just resequenced these because I added T1 there. So yeah, I've shifted my targets down. Before this was T1, now that is. And again, we'll see if it works out. Nice positive divergence. Same divergence that we had in place recently. Was thrown out in here as a trade idea most recently, and we'll see. So let's see if it pans out. Now the other ones, I'll go over the ETFs for you first. I threw out Platinum today, PPLT, in the title, and I corrected that since somebody pointed it out. Thank you. I mentioned Palladium because we just traded Palladium, or I just did, and I think I shared it as a trade idea on the site. There's a level here. That line should be turned up on PPLT. I gave you the 60-minute chart today in the update. Under the comments section of that post earlier today, but there it is. It was decent support back here, and that's the support level we're at now. A little work to be done, obviously, but also a potential bullish engulfing candle there. 60-minute chart is what I gave you with those targets today, and of course, you trade the futures, and that's PA for Palladium futures, which I will queue up here in a second. That is PPL. I'm sorry, PL. See, I'm back to my Palladium trade. That was the last trade right there. That was the target there. We overshot it, hit the target, went up, and then put in that divergent high, and that had a nice little reversal trade off there. You can see that small little bearish rising wedge right there. Clean up trend line, negative divergence at resistance. That was the next level I had above the that was my preferred price target. And then boom, nice reversal. And look, we're back to very close, minimal downside to the trend line. So I recycled back in for a long position in the Palladium today here. That's about 1956 is the support level. We were a little bit below it, but not far above this trend line. We may hit that trend line still, and I can tell you if we do, that's objective. We can also hit this support level here at 1896. So I would buy it down to, but not below that level. I would not add to a position or take a position there. Favor going in here. If we go a little lower, I'll add more. If not, we could just walk up here and come and check that trend line later on. So so far looking good. And remember the bigger picture for Palladium. You had this big primary downtrend line, big divergent low right there, and we just recently broke out. We've been stair-stepping higher. So you had a little, spike where it got ahead of itself. Nice trade we caught some of that on the way down, and but the one I gave you today is it's a close cousin. Palladium is one of the platinum group of metals along with rhodium, and PL is the one I'm looking for. Bear with me. There it is. Okay, this is the chart I gave you this morning. I'm going to zoom in a little tighter, but before I do, you can see why this is right now the current final target, about 896.60 or so. It was nice support there. We checked it again there, checked it again there, checked it again there, and then broke it, back tested again. So it's a nice level, and that is my near-term target if this one should pan out. I'll zoom in a little tighter. You've got the not requisite, but I do like to see them, positive divergences down below. You had divergence right here, and you had a little wedge, right? And that wedge broke out, and that took us up to that trend line, and then we made a marginal new low, and we had a very clean trend line. So this is one I got a price alert that fired off. I had a price alert set right here today, and so as soon as that went off, I knew the breakout happened, got that post out to you guys. That's it. So it either works or it doesn't, like anything else. Don't put all your eggs in one basket. Don't put them all on precious metals. Don't put them all in the stock market. Don't put them all in treasury bonds. But as of now, I'm liking what I'm seeing lately. So all we need is the, which I'm going to get to in just one second. It would really help to see the euro continue to get some traction to the upside. And so my targets, I already drew them out. Trend line first. 878 and change right there, 896 and change, and that would be for now. Let's see if we can get that. That'd be a nice trade. Oh yeah, I'd be remiss not to point out gold. I'm sure on gold futures. Here's a level about 1745.50. I think that'll do the trick if we can pop it. Gold futures should run up here to this downtrend line right there, And if we can pop that 1805, 1806 right there. And ultimately, there's a whole lot of resistance here. We had a trading range, a multi-month or about a month-long trading range. So it's probably going to meet some resistance at the bottom of that. But if we can work its way up, then that would be bullish. And again, we'll look at things on the daily chart, such as those bullish engulfing candles, because that may signify a more lasting trend reversal. These are just near-term targets. Swing it up to that trend line of that 1806 level. And then silver, I'm liking silver a little bit more, a little overweighted there compared to gold. This is a 60-minute chart of silver futures as well. You got a nice clean bullish falling wedge pattern on the 60-minute chart right there. You can draw out big divergence forming, and just like gold, it has this recent area of consolidation, and it needs to pop that, and to pop it, it needs to take out about 1933 or so. And it should be pretty smooth sailing up here at about the 2061-ish level right there, which again is the bottom of that month-long or so trading range. And so that would be a near-term target there for you. Let me measure it out. If you're going to trade the ETF, which is SLV, or the minor stocks, from where we're at now, that's going to be, from the breakout point, that would be about a 7% rally to get there. So not a bad trade at all, especially if you trade silver futures, because as you know, if you do, they are leveraged. So that'll put some pretty pennies in your pocket if that pans out. Like anything else, if it doesn't, stops below, and you could have taken the breakout, and which I did, and then I'm going to add if we can pop above this recent consolidation range there. Okay, it's a little too early to call this one, but I like what I see so far. So now today, super hot inflation numbers. Fed funds futures shot up from a virtual nil or very low chance of a 1% hike to a vastly favorable a chance of a hike, as I showed you. It shot up above 75% chance. And so initially, because the numbers were hot, the euro dropped. Why? Because remember, if the Federal Reserve raises rates, that is bullish for the U.S. dollar. That is pretty much a constant. But it's how traders, remember, they haven't done anything yet, and it's what traders and investors will think will happen, not necessarily what has happened. So right away, as expected, the euro got smacked down on those hot CPI data released at 8:30 a.m. right there. Right, that's the 8:30 mark. Boom, big drop. But then something different happened. They turned around and they bought all of it up and then some. Now, given a lot of that rally's been faded, but we're back to about where we started there. And this is, again, just a 1-minute chart to show you what happened today. So I think right now, look, the professional community, they don't know what to do. They don't know up from down, and I don't pretend to have it all figured out, but I can tell you this doesn't jive with that Fed funds future, which has, again, been sinking. We'll go back to that again. What was it, over 70%, 78%, I think, when we started the video. Let me just see if that's sunk. It already dropped to 72. Let me refresh the page. And back to 75. All right, so we're about where we're at there. But so the euro's given back some of the gains, but it's still positive for the day. And remember, this is how the 60-minute chart looks. This is what I shared as an actual trade idea. I've been covering the euro for a while, but I usually don't post as a trade idea, and I did. I gave you some targets just the other day because we broke out of this little 60-minute bullish falling wedge pattern right there. We've been working our way up. We had a double bottom. We retested the recent low, held, and had a nice spike up, and we're still above it. So right there is our previous high. That's where we pulled back to. So it'd be ideal to see the euro continue up here. The positive divergence indicates that's likely. And then if this happens, then it just doesn't jive with a 1% hike unless the ECB is going to come out now and talk about tightening there. Remember, currencies are relative to one another, and the dollar and the euro being the biggest component of the dollar index, so it's all relative to one over the other, who's going to be more hawkish, who's going to be more dovish. And then, of course, there's so how are the books of the country, those countries, the European Eurozone or the U.S. But right now, this is what traders are focused on. And again, and I think you know this, but the euro and gold and silver and precious metals tend to move positively correlated. If the euro goes up, gold and silver should rise as well. And so that's what I'm looking for and favoring. And then of course, if we can take out the trend line, probably have a reaction. You know, if you want to trade a quick move up, you know, I'm sure you'll get some sellers will pull back in there, maybe some consolidation, then get a breakout and head up here to that second target, which right now is my preferred swing target. What does that mean? Means that if I had to, you know, fly around the world for or get on a boat and travel around the world for a month, and I didn't have wasn't in front of the computer to game a pullback there, I would just set my OCO orders, which means one cancels the other, and I would have a sell limit order set just below that resistance level and a stop loss that would be commensurate using, you know, a 3-to-1 risk reward ratio. You know, look at 3 units of gain potential from the breakout. And then calculate about 1 unit of loss. Again, that's a rough rule. You know, I'd like to look at support levels too, but there are no support levels below because we're at a multi-year low in the euro. So the whole thing is, and remember, the way things work is, should that happen, and that's just a, you know, relatively small bounce target. Here's the next potential target. But should that happen, that gets us up back to about the 103.8 level right there in the euro. And that has the potential to bring us back into up to or into this major long-term support zone. So if that happens, then this breakdown proves to be a false breakdown, aka whipsaw, aka bear trap, and there's potential for a whole lot more. So we'll see what happens. As of now, maybe we just get a back test and then the trend continues. So we'll take it one day at a time. That's why the chart trade was laid out on the 60-minute chart. And if and as this develops, we'll see what's going on in the stock market and the economy and with the Fed and with the ECB and the Bank of Japan, because the yen's the second largest component of the dollar index. All those things kind of factor into my analysis there. All right, we're right on the 32-minute mark. Let's wrap it up here. Again, that gives you my thoughts on the stock market, what to watch for. Again, I can't say this enough. We are about to embark on earnings week. After tonight, 4 p.m., closing bell. That's it. Starting tomorrow morning, JP Morgan before the bell, followed by a slew of the majority of the remaining big financial institutions on Friday. And so that's officially kicking off earnings season tomorrow morning. And then we're going to officially conclude earnings season, I guess, or at least my conclusions, at the end of the month when you have the big fangs, Apple, Microsoft, Meta, the old Facebook, Alphabet, all those guys report in late July. All right, and until then, it's going to be volatile, but like I said, for the time being, I'm maintaining my long and bullish near-term and intermediate-term outlook on the market, and if that changes, I will let you know as soon as it does. This has been Randy Finney with Right Side of the Chart. Have a great day.